Chief Investment Strategist David Waddell. David, what are you looking for most importantly in terms of what companies present us with next week?
Well, I think the earnings are going to be absolutely astounding, right? I mean, going into the first quarter, analysts expected earnings to grow 25%, and they grew 50%. Now they're expecting 63% earning growth. The guidance going into the quarter has been at a record level. So it's just going to be astounding. I think what's going to be interesting is more the corporate comments that are forward-looking relative to the Delta virus, offshore and onshore relative to those supply shortages. I mean, I'd much rather have an issue where we've got a supply shortage than a demand shortage. So I imagine those supply issues will be resolved. I think corporations are extremely healthy. There's obviously a sea of liquidity out there supporting anything they want to do at now even lower interest rates. So I think what's been astounding maybe through this whole experience around COVID has been how resilient and resourceful U.S. corporations have been. So I expected it'll be another astounding earnings season. And by the way, that should continue on for the rest of the year. Analysts now are predicting 35% growth across the S&P for the rest of the year. And the mid caps and the small caps will do even better than that.
So give us the context then on what you're advising people should do with the fact that we will see declines. As ungrateful as it sounds to go from 50 to 35, stocks are forward-looking pricing mechanisms. What do you do with that, the fact that the biggest bulge of earnings is behind you?
Well, I think you referenced the macro issues earlier. I think they're really in control. So if I can sort of jump on that topic real quick. Global case counts bottomed in early June and started rising higher. In the U.S., we didn't really notice that because we're 51% vaccinated and the Delta variant's not particularly lethal. But offshore, you had a serious risk-off trade, right? And so that's what led to money flooding into the U.S. Treasury market, which took rates down, took the dollar higher, took large-cap U.S. growth stocks higher. So offshore, you have sort of this Delta macro concern. Onshore, we sort of scratched our heads and said, why is the 10-year going down? Uh-oh, we may have growth issues. Why do we have growth issues? Well, I don't know. We'll shoot first, ask questions later. Let's rotate away from the reflation trade. But as I said, the growth issues are really tied to supply. Supply will come back online, which is why the Fed's not worried, which is why inflation expectations are rolling over. So right now, even though we're hitting new highs, it's been somewhat low conviction. My expectation is investors get excited once they realize Delta's not all that lethal and those supply issues get resolved. So I think as investors, you use this as an opportunity to reflate, if you will, the reflation trade.
Well, and I can understand why that is great for especially the small and mid cap companies in terms of growth right now. And I wonder, you know, people talk about rotating into other regions, Europe and Asia, into EM as they start to open up, or when they do start to open up in the case of the developing countries. But of course, if you look at the big caps in the U.S., they sell stuff to all those people as well. So won't they profit off those other reopening economies too?
They will. Large cap U.S. growth stocks are priced at 28 times earnings, large cap values at 17 times, mid caps are at 17 times, small caps are at 17 times, Europe's at 17 times, EM's at 14 times. So if you start thinking about the spread between earnings yield and real yield, rising rates are just going to drive people to places with higher earning yields.
David, I've got a great context there. I got to jump in though because the president is walking out.